I've been thinking a lot about retirement recently. Not my own retirement. I'm 94 years old and I have no intention of retiring. But retirement in general, how people get ready for it, how they pay for it, what they do well, and where they go wrong. And I've noticed something deeply concerning. Most people approach retirement in completely the wrong way. They work for 4 decades, put some money aside, and then simply hope it's enough. They don't have a real plan. They don't own the right assets. They're just hoping for the best. But hope is not a strategy, and when you reach 65 and suddenly realize you don't have enough money to stop working, it's already too late. You've run out of time. You've run out of years for compounding to work in your favor. You're trapped. That's why today I want to talk about the 5 assets you must own before you retire. Not assets you should own, assets you must own. These are not optional. If you want a safe, comfortable retirement, these 5 assets need to be part of your portfolio. And I'm not going to discuss exotic hedge funds or complex financial tricks. These are straightforward, time-tested assets that have worked for generations. Assets that produce income. Assets that protect you from inflation. Assets that allow you to retire with confidence instead of anxiety. So let's begin with the first and most important asset you need before retirement. That is a diversified portfolio of dividend-paying stocks from companies with long records of raising their dividends. This is the backbone of retirement income, not bonds, not annuities, dividend-paying stocks. And let me tell you why. When you retire, you need income. You're no longer earning a paycheck, so your investments must pay you. There are only 2 ways to generate that income. You can sell pieces of your investments, gradually eating away at your principal, or you can collect dividends without selling anything. Which option sounds better? Obviously the second. When you sell shares to fund retirement, you're on a ticking clock. Eventually, the money runs out, and if you live longer than you planned, you're in serious trouble. Dividends are different. Dividends can last forever. You keep ownership of the shares, and the companies send you payments every quarter. And if you own the right companies, businesses that raise their dividends year after year, your income grows as time passes. Think of companies like Coca-Cola, Johnson & Johnson, Procter & Gamble, and McDonald's. These firms have been paying dividends for decades, and they've increased those payments every single year for 20, 30, even 50 years or more. That's exactly the kind of asset you want heading into retirement. Not speculative growth stock, not risky bets, but steady, dependable, dividend-growing companies that will reliably pay you for the next 20 or 30 years of your life. Here's how this plays out. Imagine you retire with $1 million invested in dividend-paying stocks yielding 3%. That's $30,000 a year in income. For most people, that alone isn't enough, but these aren't static dividends. These are dividends that grow. Suppose they increase at 7% per year. After 5 years, you're collecting around $42,000 annually. After 10 years, about $59,000. After 20 years, roughly $116,000. Your income doubles, triples, even quadruples throughout retirement. While Social Security barely keeps pace with inflation, your dividend income pulls far ahead. That's the power of dividend growth. And here's the best part. You never had to sell a single share. Your original $1 million stays invested and continues growing. You can leave it to your children if you want. The dividends are pure income generated from the profits of excellent businesses. I've lived on dividend income my entire adult life. Berkshire doesn't pay a dividend, but I own plenty of other stocks that do, and that income has increased year after year after year. It's the most dependable income stream you can have. So that's asset number 1, a diversified portfolio of high-quality dividend-paying stocks. Not just any dividend stocks, but strong companies with recognizable brands, durable advantages, growing earnings, and long histories of raising dividends. Build this portfolio before you retire. Own 10, 15, maybe 20 companies across different industries and plan to hold them forever. That's your retirement income engine. Now let's move on to the second asset you need before retirement. This one is different from the first. It's a low-cost S&P 500 index fund that you never touch. I know what you're thinking. Didn't you just say to buy dividend stocks? Yes, and you need both. Here's why. The dividend stocks are your income machine. They send you cash every quarter. That's what you live on. The index fund, on the other hand, is your growth engine and your protection against inflation over the long run. Even with dividend growth, you may encounter periods of high inflation, unexpected expenses, or you may simply live longer than you anticipated. You need assets that continue growing in value, assets you can access if necessary. An S&P 500 index fund gives you ownership in America's 500 largest companies. Over 20 or 30 years, it grows alongside the economy. Historically, it has delivered strong returns. You don't manage it. You don't pick stocks. You just own it and let it compound. It's your backup plan, your safety net, your silent growth engine that keeps working long after you retire. This is how I think about it. Your dividend portfolio is like your checking account. You draw income from it regularly. Your index fund is your savings account. You leave it alone unless there's a real emergency. Imagine retiring with $700 in dividend stocks and $300 in an S&P 500 index fund. The dividend stocks produce income. The index fund simply grows. Over 20 years, based on historical averages, that $300,000 could grow to around $2 million. Meanwhile, your dividend stocks have been paying you the entire time. You've lived comfortably, and now you also have a significantly larger nest egg. That's the advantage of owning both. Dividends provide income. Index funds provide growth. Together, they form a retirement portfolio that's extremely resilient. That's asset number 2, an S&P 500 index fund you hold forever and only touch in true emergencies. The third asset you must own before retirement is absolutely critical: real estate that produces rental income. And I'm not talking about the home you live in. Your primary residence is not an investment, it's an expense. Yes, it may rise in value, but it doesn't generate income. It costs you money in taxes, insurance, and upkeep. I'm talking about rental property, residential or commercial, that provides monthly cash flow. This is one of the strongest retirement assets you can own. Why? Because rental income is incredibly stable. People always need places to live and work, and rents generally rise with inflation. As your expenses increase in retirement, your rental income tends to increase as well. Real estate also adds diversification. It doesn't move in lockstep with the stock market. When stocks crash, your rental properties still produce income. Tenants continue paying rent. That stability is priceless in retirement. Let's look at a realistic example. Suppose 10 years before retirement, you purchase a rental property for $300,000. You put $60,000 down and finance the rest. The property brings in $12,000 per month in rent. After covering the mortgage, taxes, insurance, and maintenance, you net about $300 per month. That doesn't sound impressive at first, but over 10 years, the mortgage balance declines, equity builds, and the property likely appreciates. Most importantly, by the time you retire, the mortgage is paid off or nearly paid off. Now that same property might generate $500 per month in net income. That's $18 a year in steady, inflation-protected cash flow. Own 3 properties like that, and you're earning $54,000 annually from rent alone. Add dividends and Social Security, and retirement suddenly looks very manageable. Now, I understand that not everyone wants to be a landlord. It takes effort. There are inconveniences. But the work is worth it for the dependable income real estate provides. Alternatively, you can invest in REITs, real estate investment trusts. These companies own and manage properties and distribute most of their income as dividends. You get exposure to real estate without managing tenants yourself. One way or another, you need real estate in your retirement portfolio. It has preserved wealth and produced income for centuries. Don't retire without it. That's asset number 3, income, producing real estate or rights that deliver stable cash flow and rise with inflation. The fourth asset you need before retirement is Treasury inflation-protected securities, known as TIS or I bonds for shorter-term needs. I know bonds aren't exciting and traditional bonds perform poorly during inflation, but types are different. They are specifically designed to protect your purchasing power. Here's how they work. The principal value of a TIPS bond increases with inflation. If inflation is 3%, your principal rises by 3% and you earn interest on that higher amount. That means your purchasing power is preserved. You even gain slightly because you earn interest on top of the inflation adjustment. Why does this matter in retirement? because inflation quietly destroys fixed income. If you retire earning 50 a year and inflation averages 4% for a decade, you lose about a third of your purchasing power. That 50,000 only buys what 33,000 did when you retired. That's devastating. Type S prevent this. They ensure that a portion of your portfolio keeps pace with inflation no matter what. That peace of mind is invaluable. I'd suggest allocating about 10 to 20% of your retirement portfolio to TICE. Not too much. Stocks and real estate are better for long-term growth, but enough to provide stability and inflation protection. Think of TPS as your defense. Stocks and real estate are your offense. They grow your wealth. TICS protect it. That's asset number 4, ICE or I bonds, your inflation shield in retirement. Now we come to the fifth and final asset you must own before retiring. And this one surprises many people. It's a paid-off home, or at least very low housing costs. Earlier I said your home isn't an investment, and that's still true. But owning your home outright before retirement is one of the smartest financial decisions you can make. Housing is usually your largest expense. If you're paying $2,000 per month in rent or mortgage during retirement, that's $24,000 a year. Over 20 years, that's nearly $500,000. If your home is paid off, that expense drops to property taxes, insurance, and maintenance. Maybe $6,000 to $8,000 a year instead of $24,000. You've just freed up $16,000 annually. That means you need far less retirement income. Instead of needing $60,000 per year, maybe you only need $45,000. That's a much easier goal. Low housing costs also provide flexibility. If your investments have a bad year or you face unexpected medical bills, your budget can handle it. Let me be very clear. If you're approaching retirement with a mortgage, paying it off should be a top priority. Not upgrading your car, not taking luxury vacations, not remodeling your kitchen. Pay off the mortgage. Yes, mathematically, it can make sense to invest instead of paying off a low-interest loan. But retirement isn't only about math. It's about security and peace of mind. Owning your home outright, knowing no one can take it from you, is worth far more than an extra percentage point of return. If you're younger, here's my advice. Buy less house than you can afford. Choose a 15-year mortgage instead of a 30-year. Pay it down aggressively. Make extra payments whenever you can. Aim to have your home paid off by age 60 at the latest, ideally sooner. That gives you years before retirement to build other assets without a mortgage draining your cash flow. If you're older and still carry a large mortgage, you have two options. Commit to paying it off before retiring, even if it means working longer, or plan to downsize at retirement. What you cannot do is retire with a large mortgage and hope everything works out. That's financial suicide. You're entering retirement already handicapped. So that's asset number 5, a paid-off home or very low housing costs. It may not grow in value like other investments, but it makes retirement dramatically more affordable. Let's recap the 5 essential assets that form the foundation of a secure retirement. First, a diversified portfolio of high-quality dividend-paying stocks that generate growing income. Second, a low-cost S&P 500 index fund you never touch, providing long-term growth. Third, income-producing real estate or REITs that deliver stable inflation-adjusted cash flow. Fourth, Treasury inflation. Protect securities that defend against inflation. Fifth, a paid-off home or minimal housing expenses that reduce the income you need. Now let's talk about how much you might allocate to each, because that's what everyone asks. For someone planning to retire in the next 5 to 10 years, here's a general framework. This is not personalized financial advice. Consider putting 50 to 60% into dividend-paying stocks. These are your primary income source. Allocate 20 to 25% to an S&P 500 index fund for long-term growth. Put 10 to 15% into real estate or REITs for diversification and income. Hold 5 to 10% in TICE for inflation protection. And then there's your paid-off home, which sits outside your portfolio but is essential to your security. These percentages can vary. More conservative investors might want more TIPEs. More aggressive and healthy retirees might prefer more stocks. The key is owning all 5 asset types. They work together. Dividend stocks provide income. The index fund provides growth. Real estate provides inflation-adjusted cash flow. Types provide stability. A paid-off home keeps expenses low. Together, they create a retirement portfolio that can withstand almost anything. Market crashes, your real estate and types help stabilize things. Inflation, dividends, and rents rise. Longevity, your index fund keeps growing. High expenses, your low housing costs help you cope. That's a retirement built on confidence, not hope. Confidence backed by assets that have proven themselves over decades. Finally, let me address some common mistakes. The first is putting too much money into bonds. Many people think retirement equals conservative investments, so they load up on bonds. But bonds don't grow and they don't protect against inflation. In high inflation, they quietly destroy wealth. Retirement can last 30 years or more. You need growth assets. The second mistake is retiring without enough income-producing assets. Some people retire with $1 million in growth stocks that don't pay dividends. Then what? They're forced to sell shares to survive. One bad market, and they're in trouble. You need assets that pay you without selling principal. The third mistake is retiring with a mortgage. I cannot emphasize this enough. A mortgage in retirement dramatically raises your required income and risk. Pay it off first, then retire, even if that means working longer. The fourth mistake is failing to diversify. Putting everything into one asset type is dangerous. Different assets perform well at different times. That's why you need all five. The fifth mistake is starting too late. You cannot build a retirement portfolio in 5 years. It takes decades. Dividend portfolios need time. Real estate needs time. Index funds need time. If you're in your 20s or 30s, start now. If you're in your 40s, start immediately. If you're in your 50s and haven't started, you need to act fast. Time is running out. Here's a simple roadmap. In your 30s, focus on index funds and begin your dividend portfolio. In your 40s, add real estate, buy TIAs, and accelerate mortgage payments. In your 50s, aggressively build all 5 assets. In your 60s, if you haven't done this, you either work longer or lower your expectations. There's no shortcut. Retirement doesn't wait. Wherever you are, start today. Buy your first dividend stock. Invest in an index fund. Research real estate or REITs. Purchase TIPes. Make an extra mortgage payment. Take action. I've seen too many people reach retirement unprepared, believing they had more time. They didn't. Some are still working at 65 because they have no choice. Others are retired but constantly stressed about money. That doesn't have to be you. If you build these 5 assets consistently, you can have a retirement that is not just comfortable, but secure and confident. I've watched hundreds of retirements over my lifetime. The good ones always come down to the same thing: the right assets. Don't leave your future to chance. Build these assets. Start now. Stay consistent. Retire with confidence, not fear. That's the path. Follow it, and retirement can be one of the best chapters of your life, not one of the most stressful. Thank you for listening. Now go build those assets. Your future self is depending on you. Good luck.